All right. Here we go. Here we go. Here we go. The business report. Oh, they only got little. 1, 2, 3, 4, 5. Can we do 5?
William Siemens puts his life on the line as a security guard for a base wage of just over $1,000 a week.
The industry does need a pay rise. A lot of people don't realise security officers, wherever we are, we're on award. That's our base.
All industry awards and the minimum wage are going up by 3.5% in July.
This inflationary episode is now over. This provides us with an opportunity to go at least some of the way towards correcting what has happened over the last 4 years by awarding a real increase.
Fair Work's annual ruling gives the lowest paid workers an extra 85 cents an hour to just under $25, bringing the minimum wage up to $948 a week or $49,000 a year.
It's a great outcome because it's 1.1% more than inflation.
The union movement had lobbied for an increase of 4.5%, while the government asked the Commission for an economically sustainable real wage rise.
This decision will not just help them get by, but will start to help them get ahead.
I think the Commission could do better. We're dealing with the poorest 20% of the labour market. They only account for 10% of total labour costs.
Business groups were lobbying for much less.
Retail, hospitality, restaurants and cafes, they've been doing it tough. Many of those small businesses will really struggle to afford an increase of this magnitude.
The Commission says it's satisfied that businesses can handle this higher wage bill. It says that profits have been steady and that business conditions are likely to improve as lower interest rates boost spending power.
These people aren't going to go out there and blow inflation. People on these wages will get maybe, a McDonald's meal for their kids.
With the interest rates, with this, it's a start.
The ACTU wants an even bigger boost next year.
That's good. That's good. It means that not just get a McDonald's Happy Meal, get a bigger meal later. Like, increase your payments. They're doing that. The families are going out for dinner to a club, to a place to spend $50 to $60 or $20 once a week. What's this one?
Bitcoin ATMs. These things are popping up everywhere.
They are increasingly being used by scammers.
If you answer yes to any of them, you're likely being scammed.
Money laundering, drug deals, and money mules. Cryptocurrency ATMs have been making global headlines for the wrong reasons.
It's time for the cryptocurrency industry to step up.
Now Australian authorities are intervening.
We're only worried about people being victims of scams. We're worried about drug purchasing and other money laundering activity happening through cryptocurrency ATMs.
As banks crack down on scams and money laundering, criminals are turning to crypto ATMs, which turn cash into digital currency in online wallets.
Australia is certainly a very key target, given that we have high levels of savings and wealth.
The machines are found across the country in places we all visit, from shops to petrol stations. In 2019, there were just 23. Now there are more than 1,800. AUSTRAC analysed 3 months of crypto ATM transactions from 9 operators and confirmed the machines are being used in scams and fraud.
We're concerned that it could be as high as 1 in 10 illegitimate purposes in these transactions.
The Financial Crimes Regulator estimates $275 million is moved through the machines in a year across 150,000 transactions. 99% were cash deposits. The majority of users were aged over 50, accounting for nearly 72% of all transactions by value.
And it does match that cohort of the population that are being targeted by international scammers.
The ABC understands Austrac has traced some transactions to scam hotspots in Asia and Europe and linked them to organised crime networks. Last year, Robert, whose name we've changed for privacy reasons, unwittingly became a money mule after applying for a job he found online. He was sent money by a fake UK employer and told to withdraw it and redeposit it using a crypto ATM.
I just followed her instructions, and then that went on. It took me probably about a good half hour because I've never used those machines before.
Robert laundered thousands of dollars for overseas criminals before his bank flagged suspicious activity.
When I got the notification, and I was thinking to myself, maybe these people might be into something a little bit, fishy.
Just shows the proliferation of them all throughout Australia.
In just 12 months, Australians lost at least $3 million to scams involving crypto ATMs.
I'm aware of a particular case where an elderly gentleman was involved in a romance scam type situation, and unfortunately was convinced to part with $1.4 million.
Make sure to insert one bill at a time.
Cash that goes into them is almost impossible to recover.
This is organised cybercrime. They're incredibly well drilled when it comes to their scripts and the way that they will manipulate us.
While in countries like the UK, crypto ATMs are banned, here in Australia, the regulator Austrac is imposing new conditions on operators, including $5,000 limits on transactions, mandatory scam warnings and stricter reporting obligations. It's also refused to renew the registration of one crypto ATM owner, Harrow's Empires. The industry says most users are legitimate traders with little choice but to bypass mainstream banks.
One of the challenges that Australians have is if they want to buy crypto, sometimes their banks won't allow them to buy crypto, so they have to withdraw cash and then they can go to a crypto ATM and they can buy crypto that way.
Austrac says broader regulation is needed to stop the ATMs being misused by scammers and criminals. Would that still make it a profitable industry to be in for the operators?
Well, I think no one's been able to crack the code of how to stop scams. The biggest banks in Australia haven't been able to completely eradicate that risk.
A lucrative industry on notice.
Whoa, Carabra.
How has Choosy misled customers?
The case that ASIC's filed today alleges that Choosey's misled customers by representing on its website, in television advertising, on the radio and in social media posts, that it is comparing products from a range of insurers.
Okay, how do we know she's lying or something? Lie like mysteriously convicted rapist, wrong, whatever. She's a bitch.
I think the language it uses are from a leading range of insurers, and our concern and the allegations in the case are that that is not, in fact, the case. Choosy is only comparing one insurer, Hanover Insurance, and so we're concerned that the representations to those consumers who looked at the website and heard that.
All right, the consumers. Sorry to say. Okay.
Advertising have been misled.
Would you say customers have been ripped off?
Whether or not customers have been ripped off, what they certainly have been, we're alleging, is misled. So if you take funeral insurance as an example, the statements made to consumers are that there will be a range of insurers that are compared, and we know with the funeral insurance what was really happening is there were only 3 products that were being compared, and they were all from the same insurer. And for life insurance, there were only 5 policies actually being compared, again, all from the same insurer. So we say the allegation in this case are that those consumers have been misled.
What is the link between Choosy and Hanover?
Hanover paid Choosy over the course of this conduct, and our court documents allege about $61 million in commissions. So from a consumer's perspective, they've come onto a website, they're told we will compare a range of products from a number of leading insurers, and then what we really know is that there were not, or what we're alleging, is that there were not a number of leading insurers or multiple insurers being compared. There was but one insurer, and interestingly, that insurer paid Choosy over the course of this conduct about $61 million in commissions and payments. So that's the connection between Hanover and Choosy. Sort of in reality, what we're seeing here is the Choosy platform really being used by Hanover as just a platform to distribute its products, with no comparison going on with other insurers at all. That's the case that we are alleging.
With BYD cutting prices on close to dozens of EV models in China's market and by up to 30%, can Australian consumers expect deep discounts too?
Hopefully, yes, they can, but not anytime soon, unfortunately. I think it's going to take a while to flow through to the market.
Why is that?
Well, look, I think in China, there is just this huge amount of competition. It's the world's biggest car market. It's the world's biggest EV market. There's intense competition from a whole bunch of different car makers. And the prices of battery storage are coming down, and a lot of that's made in China. In Australia, we just don't have the level of competition yet, and we just don't have the level of demand for electric vehicles. Hopefully, the new policies from the federal government that will come into place from July the 1st will intensify that competition. To what extent we see those discounts passed on to Australia, we're starting to see a few of them, but not to the extent that you're seeing in China.
BYD sales in Australia during the month of April eclipsed those of Tesla. Despite security concerns associated with Chinese EVs, are Australians beginning to favour electric vehicles from that country?
Because, Chinese sales are growing in Australia. It's a bit of a hard ask because a lot of the brands are just not familiar to people. So people have sort of grown up with all those European and American and Australian brands that they're used to. So Chinese brands are harder to ask, but BYD have made an inroad into the Australian market. Now, that one in April might have been a one-off because Tesla was sort of impacted by logistical issues and they're waiting for a couple of ships to arrive and things like that, although their sales have been down quite sharply this year. So we'll wait and see what happens in the month of May, June and July. But look, I think Tesla used to dominate the Australian market with more than 50% in Australia. Now they're down to around 25, 30%. So that increased competition is an interesting thing, and it's probably a good thing.
We know that Tesla's sales came under pressure here after Elon Musk took on the Doge responsibilities at the direction of Donald Trump. Do you think Australians are beginning to abandon Tesla?
Look, I think there's been some of that to a certain extent. Look, there's been multiple reasons for the Tesla falls. One is the logistical problems. I mentioned there was a retooling in the factory for the new Model Y, the refreshed Model Y. And there's some people would have been waiting for that new model to come. But there's quite clearly there has been some pushback against Elon Musk. There's all sorts of surveys come out in America and in Canada and Europe about the damage that that's done to the brand. In Australia, you think it's probably less impactful than in those countries. In Canada and Germany, for instance, it's been really harsh, but I do think there's some impact. I mean, I know people who've decided to change their minds about buying Tesla vehicles. It's quite clearly having an impact. To what extent, we don't know. And we also don't know to what extent that market might be replaced by the people who really like what he's done.
Now, I'm wondering about the impact that Donald Trump's tariffs have had on China's car market. Have there been any, or is it just simply too early to tell?
Well, the Chinese car market, and one of the reasons why they're having huge amounts of discounting at the moment is that they basically have no outlets. So they basically they can't get into the US market. They've got restrictions on the European market, which means that's pretty small for them. They like the Australian market. Maybe they can't get into the Australian market. Maybe there'll be discounts here. But there's this huge fight in China at the moment for market dominance. And it's kind of what we saw about a decade ago with the solar industry. If you thought about those huge solar companies which emerged at the time, and there was this massive price war and discounting, they all built up their manufacturing capacity. Then they had to compete with each other. A lot of them went bust. But then we ended up with really low-cost solar panels, which came eventually to benefit Australia and the rest of the world. So we might be seeing the same thing with electric vehicles. And even if you go back to, say, a century ago in the US, when Ford was still rolling out for the first time its manufacturing plants, there were hundreds of different little car makers at the time. Everyone sort of thought they saw an entry into the market. Oh, we can do this, we can do this. In the end, there was price war, there was competition. Some fell by the wayside, and the market ended up being dominated by 4 really big players, and now they're down to 2 or 3. But that's kind of the way the market goes. But I think if we see with EVs, and particularly with battery costs, the same thing that we saw with solar, and many people think that did happen, that will happen, then I think we'll see the benefits, hopefully, in a couple of years' time.
And so in terms of China's market, do you expect that we are about to see some consolidation from the brands there? And if yes, which brands are likely most at risk?
Look, it's hard to say from here, but there's been a lot of squealing about the price cuts announced by BYD over the last week or 2 weeks. There's been a lot of companies which have seen their share prices fall, including BYD, but BYD is kind of like the big daddy of them all, so it might be able to afford to do that. Look, it's really hard to tell which ones might be most vulnerable. I guess the ones that are squealing loudest are probably the ones that and shouting loudest about it at the moment, because they're the ones that probably feel they're more vulnerable, have a smaller market share, don't have the deep pockets, and might themselves falling by the wayside or bought out by their big competitors.
Giles Parkinson, great to speak to you.
Thank you.
Whoa. Whoa. Whoa, amigo, whoa. 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 Whoa.
Nos, the Australian government aims for 1 million electric vehicles, EVs, on roads by 2027.
2027, with the News: the Australian government aims for 1 million electric vehicles, EVs, on roads by 2027, with the Electric Vehicle Council advocating for this target. The government has also set a target of 1.7 million EVs by 2030. Google search. The Australian government and the Electric Vehicle Council, EVC, have set a target of 1 million electric vehicles, EVs, on Australian roads by 2027. The government also aims for 1.7 million EVs by 2030. This target aligns with the broader goal of achieving a 100% zero-emission vehicle fleet by 2050, according to the Electric Vehicle Council. Electric Vehicle Council. https://electricvehiclecouncil.com.au. Australian Electric Vehicle Industry Recap 2023. The 31st of March 2024. Source: VFACTS, EVC EV Sales Database, OEM provided figures. The Electric Vehicle Council continues to advocate for Australia to aim for 1 million EV. Electric Vehicle Council. https://electricvehiclecouncil.com.au. State of electric vehicles.
Well, electric vehicles are supposed to be the way forward to a cleaner future on our roads, but are they becoming something of a political football? The Coalition has reinforced its plan to scrap Labor's tax break for EVs, claiming it will save the government $3 billion over 4 years. But the policy is raising the alarm across the clean transport industry. Scott Maynard is the Managing Director of the EV manufacturer Polestar Australia and joins me now. Scott, welcome to Breakfast.
Thank you, Sally. Thanks for having me on.
Have you had any consultation with the Coalition on this issue?
No, we haven't. And a lot of the numbers that are being quoted by the Coalition are still quite rubbery to us and not clear at all. So we would love to see a bit more detail around what's being quoted.
How much would this policy discourage those Australians who may have considered shifting to an EV if they were able to get a tax break under fringe benefits tax?
The effect would be significant. So it would be in the range of 60 to 70% of buyers of electric vehicles will novate lease those cars. And under a novated lease scheme, the tax incentive that's afforded here saves them approximately 30% on that lease arrangement and the vehicle's running costs across its lifetime. So it would put the vehicles at a distinct disadvantage were that to happen. Which really does seem to be counterintuitive to policy that we are really trying to use to decarbonise the fleet of vehicles in Australia.
One of the criticisms has been that the Productivity Commission has found that EV tax breaks unfairly benefit wealthier Australians. Do you agree with the Productivity's assessment on that point?
No, I really don't. It flies in the face of research that we hold that suggests that the strong uptake in EV vehicles is now moving into outer metro suburbs. 43% of vehicles sold are now going into those areas, and that the growth in electric vehicles in the outer metro suburbs is now surpassed that of inner city areas. So suburbs like Kellyville and Werribee are now becoming real growth pockets for EV. The novated lease scheme is available to most Australian workers, and so it would be a wide-ranging disadvantage. It's not something that's held by a few, and that's probably old policy. The vast range of electric vehicles that have been brought to Australia, we have over 100 models now available in Australia, have starting prices below $40,000, making them far more accessible than perhaps they were before.
If a tax break like this is so important for sales and keeping the industry going, does that mean, if standing on its own 2 feet, that electric vehicles really are not affordable or sustainable in Australia?
No, not at all. They're still the way to go. And even the hardened critics suggest that electrification of Australia's fleet is still the way to go. And that's not to say that it needs to be at 100%. It will find its level. But for policy that flops and changes like this, and for tax advantages, because remember, we're not talking about altering the price, we're talking about an advantage provided through tax that is so out of sync with tax advantage to vehicles like, for example, dual cab utes in Australia. And we now have sales of dual cab utes running at 1.5 the rate of tradesmen in the country that still enjoy FBT brakes and LCT brakes. And remembering, luxury car tax only kicks in above $80,000. That's costing the government $250 million a year. So it seems like a more sensible place to incentivise purchase than incentivising purchase of vehicles like that.
You're listening to Radio National Breakfast, and you're hearing from Scott Maynard. Scott is the Managing Director of Polestar Australia, and we're talking about the Coalition's promise to slash the tax breaks on electric vehicles. What do we know about sales overall of EVs in Australia at the moment, Scott?
Sales have been really, really strong up until now. So we've seen steady growth of electric vehicle sales in Australia, but still not really keeping pace with the global rate of uptake. So last year, for the full year of 2024, we saw 10% of all vehicles sold in Australia being fully electric. This year, that's...
Stop. So how the economic break? Economic Australia government economic don't know from Australia owner housing crisis singled out by global
Trump tariffs will push Australians to save more as they fret over economy. Australia's horror housing crisis singled out by global think tank. Australians' living standards are being undermined by restrictions on where homes can be built and the types of businesses being established across the nation's cities, the OECD has found in a report urging all governments to overhaul planning and competition laws. The Paris-based think tank singled out Australia as one of a handful of nations that desperately needs to make planning rules more flexible, joining a growing chorus of experts arguing the nation's economic fortunes are being hamstrung by a dysfunctional housing sector. In its 6-monthly review of the global economy, the OECD argued that the complex rules and regulations governing house construction and land use across Australia were one of the reasons behind the nation's expensive housing. It urged all levels of government to reduce red tape, arguing this would not only help bring down housing costs but enable businesses to become more competitive, which in turn would boost the nation's lagging productivity levels. A range of policy actions, including easing zoning restrictions, is needed to strengthen competition and productivity, as well as to raise housing investment to reverse the long-standing decline in housing affordability, it argued. The OECD is forecasting the Australian economy will expand 1.8% this year and 2.2% in 2026. Underlying inflation is expected to remain within the Reserve Bank's 2 to 3% target band. Financial markets put the chance of a follow-up rate cut by the Reserve Bank at its early July meeting at 80%. Markets believe the official cash rate, now at 3.85%, will be 3.1% by Christmas. Despite the improved economic outlook, the organization noted business investment was likely to remain subdued. It found Australia had a large private sector investment gap, with businesses not spending as much as they should on new equipment and buildings. The OECD said part of this was due to sluggish private demand, while a lack of competition and heavy regulations, particularly around the use of land, meant Australian firms hoarded cash rather than improving plant and machinery. Nationwide productivity was being held back as businesses and potential homeowners found it difficult to build new premises or houses. Related article. Reducing complexity and introducing greater flexibility in zoning systems, including by being less prescriptive about the specific activities that can be undertaken on a parcel of land, can enable firm entry and growth, as well as the ability of the economy to adapt to ongoing structural change, it found. While upgrading its forecasts for the Australian economy, the OECD downgraded its expectations for the globe. The world economy, after growing by 3.3% last year, is now expected to expand by a modest 2.9% this year and next. Most of the downgrade is due to the impact of Donald Trump's tariff agenda. Treasurer Jim Chalmers said Wednesday's national accounts, expected to show a slowdown in economic growth through the first 3 months of the year, would reveal the impact of recent natural disasters and global economic headwinds. This is a stark reminder of the risks posed by tariffs and trade tensions, conflict and fragmentation, he said. Those trade tensions, Reserve Bank chief economist Sarah Hunter warned on Tuesday, would be likely to lead to Australian businesses and households saving more and spending less. Minutes of the bank's most recent meeting confirmed it had considered a supersized half percentage point rate cut to offset the risks posed by the Trump tariffs. Hunter said part of the problem caused by the tariffs, the latest being Trump saying he would double steel and aluminium tariffs to 50%, was the uncertainty they caused to consumers, businesses and affected governments. Greater uncertainty about the future can lead households and businesses to save instead of spending and investing. And this is likely to be the case for Australian households and businesses too, she said. An increased borrowing costs and risk premia in global financial markets are likely to spill into domestic markets, further weighing on activity. Global uncertainty may weigh substantially on domestic activity if uncertainty remains elevated. Hunter said Trump's trade agenda would be felt through 5 different channels. Related article. These include changed trade flows as companies shift production to different countries and identify new markets. A change in spending patterns of businesses and households as products hit by tariffs become more expensive, and an increase in general uncertainty. She said interest rates and government spending may have to change to deal with the fallout from the tariffs, while financial markets would reprice all assets, including shares, government debt, currencies and commodities. The broad-based nature of the proposed U.S. tariffs, retaliation from major partners and other policy shifts all have the potential to structurally alter the world economy, she said. Cut through the noise of federal politics with news, views and expert analysis. Subscribers can sign up to our weekly Inside Politics newsletter. Shane Wright. Shane is a senior economics correspondent for The Age and the Sydney Morning Herald. Connect via Twitter or mail.
Cell by cell, this solar manufacturer has high ambitions to power up the nation.
The next step is to electrically connect all the solar cells together, and that's what this machine does.
The company's receiving funding under the $22.7 billion Future Made in Australia scheme, which promises to revive homegrown manufacturing and turn the country into a renewable superpower.
There is a global race in terms of setting up onshoring solar manufacturing all around the world. And with the right policy settings, I do feel very strongly that Australia can be highly competitive. How the strings looking, Ken? They're looking pretty good.
What will that mean for your business?
It's massive. So what that means is it allows us to get to scale, which reduces our costs and allows us to be globally competitive.
But it's going to be a tough market to crack. The industry is dominated by China.
It is true that 80 to 90% of the world's solar panels are produced in one country. However, solar manufacturing costs are changing. They're going to have to compete with nations that now have access to cheaper, cleaner electricity.
In the budget, there's more than $27 million for reforms to support rooftop solar, batteries and EVs. $3.2 billion for technologies deemed critical to energy transition. A tax incentive of $2 per kilogram for green hydrogen produced up to 10 years, and $7 billion for a critical minerals production tax incentive, worth 10% of processing and refining costs.
That'll allow Australia not just to do the mining, but to move one step further at value add.
Renascor Resources is another winner from the Future Made in Australia plan. It's getting funds to fast-track its graphite mine in South Australia.
We would expect the bulk of the material that we're going to be mining and then refining here in Australia to wind up in lithium-ion batteries and then go into electric vehicles.
To qualify for government funding, businesses must fit within the National Investment Framework, which focuses on green industries that help reduce emissions or contribute to economic security. Speaking before the budget was handed down, former ACCC Chair Rod Sims offered a warning on how the support should work.
If you are going to subsidise manufacturing in Australia, then make sure it is a subsidy and that it doesn't affect the pricing of particularly important supply chain goods for the green economy. I mean, we don't want unnecessarily high cost renewable energy.
And he says we need to be selective.
Early government support for industries where Australia has a comparative advantage. That's things like green iron, green urea, green polysilicon, things that are really energy intensive.
Intensive work to get to net zero.
The nation's lowest paid workers will this morning find out how big a pay rise they're getting from next month. Our reporter Stephanie Ferrier joins us now from Melbourne. Steph, there are different opinions on what sort of a raise we could see.
Good
Good morning, Bridget. Yes, at the moment, minimum wage earners are paid around $24.10 per hour, or just under $916 per week. Employer groups like the Retailers Association are arguing for a modest increase of around 2.5%. Some are asking for even lower than that. And they argue that this would help with cost of living relief, but at the same time not stoke inflation. And employers also argue that any real wage increase would have to be accompanied by improvements in productivity. The federal government says that it wants to see an economically sustainable real wage increase. So that means something that is above the current inflation rate of 2.4%. But we've heard from the Australian Council of Trade Unions, it's actually suggesting a 4.5% rise. And earlier on, we heard from Sally McManus on News Breakfast, the Secretary of the ACTU. Now, she says that this would help with those that have really taken a big hit due to increased inflation. And she says at the moment, some of those lowest paid workers are really doing it quite tough.
If you're a minimum wage worker, you've got no savings. And so every extra bit goes to paying your bills, but also making your life just that little bit better. During the pandemic, with inflation, people went backwards, and it's time for people now to catch up.
That's the ACTU Secretary, Sally McManus, speaking on News Breakfast a short time ago. And she also says that this is not just going to directly impact 3 million Australians. It's also going to lift the floor on wages for all Australians, with this decision typically a benchmark for wage growth across Australia. And she says during those really high periods of inflation, while businesses were able to put up their prices, workers couldn't simply put up their wages, so this is long overdue. Now, the decision and just how much workers are going to get is going to be announced in just under 2 hours from now, Bridget. All right, we wait and see. Thanks very much, Steph.
To federal politics now, and the Greens are very disappointed this morning after Western Australian Senator Dorinda Cox defected to the Labor Party. Our political reporter Olivia Casely joins us now from Parliament House to tell us more. G'day, Olivia. Senator Cox cites a loss of confidence in the minor party. What else did she have to say?
Yeah, she says that it all boils down to values, and that essentially her values align more closely with the Labor Party's than the Greens. She was, of course, a member of Labor when she was in her youth before.
When was that?
$25,035 ASIC sues FIIG Securities for systemic and prolonged cybersecurity failures. ASIC. FIIG Securities Limited (FIIG) allegedly failed to have adequate cybersecurity measures for more than 4 years. According to documents filed by ASIC in the federal court, this enabled the theft of approximately 385 gigabytes of confidential data, with some 18,000 clients notified that their personal information may have been compromised. ASIC alleges from March 2019 to the 8th of June 2023, FIIG failed to take the appropriate steps, as is required by an Australian Financial Services AFS licensee, to ensure it had adequate cyber risk management systems in place. FIIG's cybersecurity failures enabled a hacker to enter its IT network and go undetected from the 19th of May 2023 until the 8th of June 2023, resulting in the theft of personal information and subsequent release of client data on the dark web. The stolen data included highly sensitive customer information, including names, addresses, birth dates, driver's licenses, passports, bank accounts and tax file numbers. FIIG advised ASIC that it was contacted by the Australian Signals Directorate's Australian Cybersecurity Centre (ASTI's ACSC) about a potential cybersecurity incident on the 2nd of June 2023. FIIG was not aware the incident occurred before this contact. FIIG did not investigate and respond to the incident until the 8th of June 2023, almost a week after it had been notified of potential malicious activity by the AST's ACSC. ASIC Chair Joe Longo said, "This matter should serve as a wake-up call to all companies on the dangers of neglecting your cybersecurity systems. Cybersecurity isn't a set-and-forget matter. All companies need to proactively and regularly check the adequacy of their cybersecurity measures and follow the advice of the ASTI's ACSC. Advancing digital safety and resilience is a strategic priority for ASIC, and we have been actively engaging with companies to support the continuous improvement of cyber and operational resilience practices. Australian financial services licensees are required by law to have adequate cybersecurity risk management systems in place. We allege FIIG's inadequate cybersecurity measures left the business and its confidential client information vulnerable and exposed to significant risk. ASIC's allegations include FIIG's failure to have appropriately configured and monitored firewalls to protect against cyber attacks, update and patch software and operating systems to address security vulnerabilities, provide mandatory training to staff on cybersecurity awareness, and have adequate human, technological, and financial resources to manage cybersecurity. ASIC is seeking declarations of contraventions, civil penalties, and compliance orders. Licensee failures to have adequate cybersecurity protections is an enforcement priority for ASIC. This is ASIC's second cybersecurity enforcement action. In May 2022, the federal court ruled AFS licensee, Re-Advice, had breached its license obligations to act efficiently and fairly when it failed to have adequate risk management systems to manage its cybersecurity risks. 22104 Mr. Download. Concise statement. Originating process. Statement of claim. Background. FIIG provides retail and wholesale investors with access to fixed income investments and bond financing. As an AFS licensee, FIIG plays an important role in providing custodial and trading services, maintaining records of client investments, and holding funds and fixed income investments on behalf of its clients. ASIC expects AFS licensees to prioritize and invest in systems that protect their customers and maintain integrity in the financial system. AFS and credit licensees have obligations under Sections 912A, 1A, D, and H of the Corporations Act 2001, 100 to do all things necessary to ensure that financial services are provided efficiently, honestly, and fairly, to have available adequate financial, technological, and human resources, and to have adequate risk management systems. In November 2023, in response to the findings of the ASIC Cyber Pulse Survey 2023, Representative 776, ASIC called for greater vigilance from Australian organizations to prioritize their cybersecurity from threats. 23300 Mr. ASIC's regulatory resources include further information about cybersecurity and cyber resilience. Cyber resilience good practices. Cyber risk. Be prepared. Resources on cyber resilience. Key questions for an organization's board of directors. Editor's Note 1. On the 22nd of April 2025, a case management hearing was listed for the 2nd of February 2026. Editor's Note 2. On the 26th of May 2025, ASIC filed and served a statement of claim. ASIC media releases are point-in-time statements. Please note the date of issue and use the internal search function on the site to check for other media releases on the same or related matters.
Wow.
Touchstone closes flagship fund. Financial Standard. Touchstone Asset Management has closed its flagship Australian equity fund nearly a decade after it launched. The Touchstone Index Unaware Fund shuttered in May, having been in operation since the 4th of April 2016. The fund aimed to outperform the return of the S&P ASX 300 Accumulation Index by 2% p.a. over a rolling 5-year period, investing in 15 to 25 securities. It required an initial investment minimum of $25,000. According to Morningstar, the fund had $13.9 million in assets and generated 10.6% p.a. in the past year. Touchstone, an affiliate of Bennelong Funds Management, was launched in 2015 by principals Jack Chamello, Sue Ellen Morgan, and Mary Farrows. Bennelong said in a statement to Financial Standard, after consultation with the fund's investment manager Touchstone Asset Management Thai Limited Touchstone and our own analysis of the fund, we are of the view that the fund's viability was in question due to low funds under management and it was in investors' best interests to close the fund. Touchstone, however, continues to actively manage more than $1 billion of Australian equities for direct, advised and institutional clients with no changes to personnel or its investment strategy. While the managed fund has closed, Bennelong said the Touchstone team continues to manage funds invested directly through private mandates. Bennelong recently partnered with Allspring Global Investments to distribute its global income strategy across Australia and New Zealand, the Allspring Global Income Fund. The fund is a fixed income portfolio utilizing an unconstrained multi-sector approach and has a 10-year track record. It tracks the Bloomberg Global Aggregate Index and aims to achieve total returns. Allspring has $930 billion of assets under management and advisement, managing over $715 billion fixed income assets for a global client base.
is Business Weekend with Edward Boyd.
Hello and welcome to Business Weekend. I'm Edward Boyd. Coming up, President Trump's tariffs were blocked by a court and then reinstated this week on appeal, setting up a legal battle between the Trump administration and the plaintiffs, which will have massive implications for Australian exporters. American economist, author and former CIA advisor Jim Rickards will give us his take on this volatile situation.
My criticism of them would be the same as the criticism of the trade court, which is butt out. This has nothing to do with the courts. This is between the White House and the Congress.
Australian gas and energy producers are gaining confidence in the federal government after Environment Minister Murray Watt gave his conditional approval to extend the life of Woodside Energy's Northwest Shelf gas project. Beach Energy Chief Executive Brett Woods is on the program.
Long awaited for Woodside, long awaited for the industry. We all look for these markets to make sure that we're seeing government policy heading in the right direction.
Plus, Argentina's President Javier Milei was the first foreign leader to meet Donald Trump after he won the 2024 presidential election. The ex-economist is nicknamed El Loco, or the Crazy Man. Can he turn the South American nation's fortunes around with his ambitious economic strategy? Ingrid Willinge will investigate. So all that and more coming up on today's program. But first, the emergency powers President Trump used to introduce sweeping tariffs earlier this year have been called into question by a Manhattan-based court. The Trump administration is now considering changing the basis of its legal argument so it can push these tariffs through unchallenged. This week, Trump also summoned the head of the US Federal Reserve, Jerome Powell, to the White House and gave him a dressing down over interest rates. Jim Rickards is a best-selling author, economist and former CIA advisor. I spoke to him about the Fed, interest rates, and who will win the tariff war, Trump or the small businesses challenging him in court.
The White House is definitely going to win. Now, it remains to be seen what path they'll take. By the way, I'm an economist, but I'm also a lawyer, so I've been involved in this area for decades. So what happened, I think your viewers know, the Court of International Trade said that the statute that the President Trump used to impose these tariffs did not apply. In other words, you couldn't use that statute. It's the International Economic Powers Act of 1977. It's been around since the Carter administration. It's used extensively. I have a lot of experience with it. All the sanctions the U.S. has put on Russia, cartels, drug dealers, many, many other sanctions all come out of that one statute. And that's what Trump was using. Now, so the International Court of International Trade said that this act, with IEPA, doesn't apply. It can't be used. The reason they gave was made no sense at all. Now, just to be clear on the statute, it says a couple of things. It basically makes the President of the United States an economic dictator on two predicates. One is the threat arises in the international context. And two, there's some kind of emergency. So you have to declare an emergency. It has to be internationally related. Subject to that, the presidential powers are, I would say, dictatorial, and that's not, in the good sense of the word, that extremely, extremely broad. So what the court said was that that it doesn't mention the word tariffs. Well, it's true. It doesn't mention the word tariffs, but so what? It talks about sanctions, freezes, seizes, other extraordinary actions, etc. A long list of things. It doesn't have to be comprehensive. It simply has to make it clear that the president has extremely broad power to kind of do whatever he wants to deal with the emergency. So for the court to say, well, it doesn't say tariffs, so you can't use it, that's just nonsense. That's just a really bad interpretation of the law. And then they said, oh, by the way, it's not an emergency. Well, that's an executive branch power. It's up to the president to decide what's an emergency and what isn't. It isn't up to some, almost unknown court to say it's not an emergency. That's up to the president. And by the way, and here's the most important point. The statute has a built-in governor, as a built-in regulator. If the president does something and the Congress disagrees, I believe it's 90 days, within 90 days, they can pass an act of Congress saying that the president cannot use this authority. So it's not even an unchecked power. It's an executive power to begin with, passed by the Congress, and the Congress retains a check on the president's power. You don't need the courts to do anything. You don't need the courts to usurp the power of the president, and you don't need them to correct any, if he declared an emergency and you don't think it's an emergency, it's up to the Congress to say that. So this court is way out of line.
Yeah, look, well, it'd be interesting to see how it plays out, Jim. But another big story this week, Trump summoned the head of the Federal Reserve, Jerome Powell, to the White House, told him it's a mistake to not lower interest rates. Do you think the president's right here? Does the Fed need to start cutting rates immediately to help the US economy?
Well, the Fed should cut rates because we're in danger of deflation. It's not going to help the U.S. economy very much. The Fed is kind of irrelevant. I understand I follow the meetings, I read the minutes, I understand it's big news, and I get all that. But the Fed is kind of irrelevant. The money supply that matters is created by commercial banks, not by the Federal Reserve. But just to kind of put a little topspin on your story, and you're right about that, I was talking to some of the Trump transition team members, and they wanted to fire Jay Powell. This goes back, last December, before Trump was actually sworn in January. And I said, don't fire Jay Powell. There's a legal issue whether you can do it or not, but I said, don't fire him because the economy is probably going into a recession. And Jay Powell makes a very convenient punching bag, meaning when you go into a recession, just blame Jay Powell, blame him for everything, for not cutting rates sooner, not cutting them far enough, et cetera. If you fire him and replace him, then you own it. Then you're subject, you pick the replacement, so you're responsible for Federal Reserve policy. So I think the Trump team listened to that advice. They did not fire Jay Powell, and right now it's working out the way I expected, which is he's going to get the blame for any U.S. recession.
Yeah, looking at your Twitter account, I see you visited Jekyll Island last month. And for viewers that don't know, it's the place where the US Federal Reserve was basically born in the early 1900s. So you don't think the Trump administration is now going to fire Powell? They're just going to leave him there as a punching bag and take all the hits until his term ends. I think it's next year.
That's correct. His term ends in early 2026. So we may be in and out of a recession between now and then. I expect we will be if it doesn't get worse, if it doesn't turn into a monetary crisis. But the point being, yes, his term ends, I believe, it's early 2026. I think February 2026. So what's the rush? Get through a bad patch, get through a recession, and then name a replacement early next year when things will probably be better.
Yeah, look, we're in Australia here, obviously, on the other side of the world. It's hard to get a sense of how things are going economically in the US. What's the vibe like right now? Does it feel like you are heading towards that recession?
Well, I don't think that's the vibe. That's my own analysis, and there are a lot of indicators that point to that. And cutting rates doesn't matter. By the way, low interest rates are associated with recession and depression. The idea that we'll cut interest rates will stimulate the
News, Tech Council of Australia. Newsroom. Our work and latest updates. ASX 200 jumps during Tuesday's trading, news.com.au, Australia's leading news site for latest headlines. The Australia share market closed at a 3-month high thanks to trade talks between the US and China. The Commonwealth Bank hitting a record high and the RBA minutes signaling further rate cuts are coming. The benchmark ASX 200 index gained 52.60 points or 0.63% during Tuesday's trading to close at 8,466.70. The broader All Ordinaries also finished heavily in the green, up 53.40 points or 0.62% to 8,690.90. The Australian dollar slumped throughout the trading day, down 0.67% and is now buying 64.53 US cents. On the strongest day of trading so far in June, 9 of the 11 sectors finished in the green, led by the Big Four banks. Consumer staples and telecommunication services. CBA shares closed up 1.26% to $178.64, hitting a new record high on Tuesday. The rest of the Big Four are also trading higher. Westpac shares rose 1.37% to $32.62. NAB shares rallied 1.19% to close at $38.19 and ANZ shares finished heavily in the green, up 1.31% to $29.36. Telecommunications businesses were also trading higher. Telstra shares jumped 1.04% to $4.87, while Ray Group was up 0.35% to $241.13 and Car Group closed in the green, up 0.37% to $35.55. It was a mixed day for the major miners, with only Fortescue Metals trading higher, up 0.13% to $15.02. Rio Tinto shares dropped 0.66% to $110.02 and BHP lagged down 0.58% to $37.56. Part of the strong day on the ASX came from the back of potential trade talks between the US and China. With Capital.com senior financial market analyst Kyle Rada said the markets were shrugging off simmering trade tensions. Despite the doubling of aluminium and steel tariffs and some spicy rhetoric by the US and China about trade relations, Wall Street erased an early loss to end the session broadly higher, he said. In other positive news for the ASX, the RBA's minutes of monetary policy was released, with CBA economist Belinda Allen saying it confirms the RBA is taking on a more dovish tone. A July rate cut is live, given the discussion in the minutes, together with market pricing and RBA economic forecasts conditioned on a terminal rate cut of 3.2%, she said. We continue to expect 2 more rate cuts this cycle and favor an August and September cut. In company news, shares in IDP Education plunged after the language testing and student placement company's latest announcement. It says global uncertainty has seen its language test volumes fall 18 to 20%, while student placement volumes have slumped 28 to 30%. Treasury Wine Estates rose 0.49% to $8.14 after lowering its guidance and the loss of a key distributor in the U.S. for its premium wine division. Shares in gambling company PointBet entered a trading halt as it waits to announce the decision of a $353 million acquisition of the business by Japanese competitor Mixi. Pizza retailer Domino's shares were also in the red, down 2.20% to $21.76 after announcing leadership changes to its Japanese arm to support the next phase of its business turnaround. Inflation, interest rates. How RBA decided on small rate cut in May, news.com.au, Australia's leading news site for latest headlines. Global uncertainty on the back of US President Donald Trump's tariffs played a part in the RBA's most recent rate cut decision, as minutes from the meeting reveal how seriously the central bank is taking the threat of a trade war. While the Reserve Bank models all scenarios, minutes from the May 20th meeting showed the board had agreed to convey the bank was well-placed to respond decisively to international developments if they were to affect economic activity and inflation. This was described in the severe downside scenario set out in the May statement on monetary policy. Under this scenario, there would be a permanent and large tariff that surprises the financial markets, businesses and households, triggering a large global confidence shock. The RBA says in this scenario, asset prices such as bonds, house prices, shares and superannuation funds would all sharply decline. They also predict in this scenario Australia's major trading partners, including China, would see GDP fall to around 4% lower than the baseline forecast. Under one of these scenarios, the RBA says, a re-escalation of the trade conflict that primarily weakens demand could lead to a slowing in domestic activity, a sharp rise in the unemployment rate and a decrease in inflation. If the trade conflict causes material supply-side disruptions, inflation could move in the other direction. The central bank said while nervous about the extent of the impact Mr. Trump's trade policy could have on Australia's economy, it intended to move, cautiously and predictably, in line with market expectations. As such, households were not given an outsized, insurance against global growth, 50 basis point rate cut last month. Instead, the bank highlighted the need for monetary policy settings to remain predictable at a time of heightened uncertainty. The board agreed that developments in the domestic economy on their own justified a reduction in the cash rate target and that the case for that action was strengthened by developments in global trade policy, the minutes reveal. Independent economist Saul Eslake told Newswire reading the statement shows the Reserve Bank made the right decision, as the smaller cut helped restore confidence for homeowners. These are my words, not theirs, but if they were to cut rates by outside 50 basis points, people's reaction might be, what do they know that we don't? He said. If they are worried enough to cut rates by more than they normally would, then should I be worried as well? Mr. Eslake said his interpretation of the minutes was that the RBA wanted to show they were conscious of downside risks, and if those risks materialize, they are willing to act. If they actually started cutting rates by more, on speculation things might turn out bad. Then they don't have as much ammunition if things turn pessimistic, he said. You could say they were trying to build confidence by saying, yes, we know bad stuff could happen. But hey, it hasn't happened yet, and if it does, we can deal with it. Ultimately though, the board agreed, but hey, it hasn't happened yet, and if it does, we can deal with it. Ultimately though, the board agreed the case for a 25 basis point rate cut was the stronger one, as members were not persuaded that weakening global growth and domestic factors warranted an outsized rate cut. In a silver lining for households, should the impacts of global uncertainty materialize, the RBA board agreed it would need to move to expansionary settings, meaning there would be more cuts to the cash rate. The board judged in May, however, that there was not enough data around the impacts of any global uncertainty to switch to a more expansive monetary policy setting. They also judged it was not yet time to move monetary policy to an expansionary stance, taking account of the range of estimates involved. Given that inflation was yet to return sustainably to the midpoint of the target range and the staff's assessment that the labor market was still tight, the minutes read. The board also highlighted they had the firepower left to kickstart growth should the worst of global uncertainty impact the local economy. In finalizing the policy statement, members agreed that it was appropriate to convey their commitment to both of the board's objectives, the board said. They also agreed to convey that policy was well placed to respond decisively to international developments if they were to have material implications for activity and inflation of the kind described in the severe downside scenario set out in the May statement on monetary policy. Meeting for the second time under its new dual board structure, the RBA cut the national cash rate by 25 basis points, from 4.10 to 3.85%. But RBA Governor Michelle Bullock revealed a 50 basis point cut had been debated. There was an argument and we did debate it, a 50 basis point cut, but it wasn't the strongest argument in the room, Ms. Bullock said at the time. She stressed, inflation hurts everyone, particularly those on lower incomes and renters. Responding to a question from Newswire on whether households could expect further relief, and what message she had for those doing it tough, she acknowledged Australians had gone through a really rough few years, accentuated by sharp rises in everyday prices. I would say that bringing inflation down is the best thing we can do to help them, while keeping employment strong, she said. At the moment we are on track to deliver that. I know you're doing it tough, but conditions are improving. Read related topics. Donald Trump.
The annual rate of inflation in Australia remains stable at 2.4%. Inflation's now at 2.4%. How worried are businesses still about inflationary pressures?
Yeah, so interestingly, over the last year or so, a year or so ago, inflation was by far the biggest worry for businesses in Australia. And now that's come down and, in fact, been overtaken by global geopolitical worries as the biggest concern for Australian businesses. And I think we all know the reasons for that. So certainly inflation... moderating, declining is the biggest concern for businesses, and that really, I think, supports the...
SBS Audio is supported by advertising.
From breaking news to all the major developments around the world, the SBS World News team brings you a weekly podcast on the biggest stories shaping our world. Whether it's conflict zones, climate updates, or diplomatic breakdowns, we've got
0.15%. Hi everyone, it is Thursday the 29th of May 2025. Well, the Australian share market rose today by 0.15%. That's despite strong US futures following a 69% rise in quarterly earnings at chip maker Nvidia, and after a US court blocked Donald Trump's reciprocal tariffs. So to find out why the Australian share market underperformed those strong US futures and for what it means for the market, I spoke with Todd Hoare, Chief Investment Officer at LGT Crestone. So, Todd, a US court has ruled Trump's use of emergency powers to implement reciprocal tariffs as unlawful. Should we have seen this coming, and should the market have seen it coming?
Well, Ricardo, I think no one had actually heard of the International Emergency Economic Powers Act of 1977 until today. So I'm not necessarily convinced we should have seen it. I think the implications are quite important. I think one of the main points is that we've not historically seen a ruling like this where we've wound back in its entirety a president's signature policy. And I think that speaks volumes for the importance of today's decision.
What do you think it means for investor confidence, though? Does it really help with uncertainties? Because if anything, does it add to these uncertainties? Because Trump could be appealing, or he's not, he is appealing it.
Yeah, I think certainly he will appeal. And so to some extent, the fact that in the best situation, the Supreme Court won't make a decision for probably 12 months. At the lengthy end, we've probably got till mid to late 2026 before the Supreme Court could actually rule on this, which gets you into the midterms and some complications associated with that. So even under a best case situation, we've still got significant uncertainty as to how this will play out. I think importantly, there are a host of other uncertainties that relate to this. If you are negotiating with Trump on tariffs, you have now no incentive to negotiate at all. If these decisions ultimately get overruled in the Supreme Court and a country potentially has not negotiated in good faith with President Trump, how does his reaction function deal with that? Does it make it worse for those countries? So there's a lot of game theory that will actually play out of all of this. And I think potentially the big thing that markets will need to grapple with is this big, beautiful bill that was recently passed. Obviously, a big component of that was these tariffs and their revenue-raising impact to actually control that deficit. So if we no longer have that revenue component associated with that big, beautiful tax bill, that big, beautiful bill rather, what does that mean for bond yields and the federal deficit? So yes, there is still likely to be considerable uncertainty.
How would you describe the way the markets have been reacting so far to this? Because we're seeing US futures rising, but here locally, the Australian share market hasn't done much. Is it a fact of they're looking through what you've just described and that confusion, or are Aussie investors anyway kind of waiting to see how the US will react? Because this decision came after the markets closed in the US.
Yeah, I think we are seeing a risk-on mentality. So you've seen it with US futures, as you pointed out. You've also seen it with the US dollar. So the US dollar has strengthened against those safe haven currencies like the franc and the Japanese yen. I think specifically to Australia, one of the main reasons that we are potentially acting as a bit of a lag a little bit compared to what we may have otherwise seen.
And finally, before this actually happened, the president was asked overnight to respond to the idea that the markets are rising on what's being called the taco trade. Trump always chickens out, referencing his negotiations with China and the EU, right? Is that a thing? And what will this latest development do to that taco trade?
I'm not sure he will appreciate that moniker at all, but I think there's probably a subtle truth to that acronym, but it's more around the fact that there are guardrails in place. And I think the events of this morning actually prove that we still have those guardrails. So we've seen Trump backtrack when the equity market and the bond market reacted negatively, and he started to negotiate with other countries. So that was the first guardrail I think the fact that the courts today have overruled him will instill a sense of confidence in the institution and the judicial process. So there's another guardrail. I think the fact that he also, for want of a better term, bashed the Federal Reserve, bashed Powell only 3 to 4 weeks ago, and yet here we are with that institution intact. I think the markets are looking at these guardrails and saying we can now put Trump into a particular lane. He can be volatile within the parameters of that lane, but the institutions, the Federal Reserve, the bond market, the equity market, the judicial system will not allow him to get outside of that lane. And that, I think, for markets in particular, that will give them confidence because they can price those guardrails. When you are moving in and outside of those guardrails, it becomes very difficult to price that risk. Now that we can price that, I think markets will move forward with a sense of greater stability than what they otherwise had.
And finally, and just wrapping all this up, I know there's lots of other influences impacting the way people invest, like yourself. How do you navigate this uncertain environment as an investor?
I think one of the things that we are very, very conscious of at LGT Crestone is that we knew and we always expect that this was going to be a volatile period. So having a disciplined investment approach in place beforehand doesn't necessarily mean you predict any of these things, but you can be reactionary probably a little bit quicker than what we otherwise would be. And I think our overarching philosophy is just having a constraints-based approach to investing, i.e. let's not worry about what is said by politicians, by regulators, or the like. Let's worry about what can actually get done within the parameters of global trade, markets like the bond market, etc. And if we operate with those parameters in mind, we actually get a greater sense of what can occur, not necessarily what we suspect might occur, and we're not jumping at shadows. So I think a constraints-based approach is probably, for this day and age, perhaps the only real way to invest.
That is Todd Hall there from LGT Crestone. So to go into more detail about the market's rise of 0.15%, underperforming US futures today, that's on the S&P ASX 200, and to break down NVIDIA's spectacular result and to take a closer look at where AI is going, I spoke with Amina Rosenberg, a portfolio manager at Minute Hall Capital. Amina, it would appear that the local market hasn't necessarily reacted too optimistically to a US court reversal of Donald Trump's reciprocal tariffs. Why do you think that is? Or is it a case of investors here waiting for the US to open because futures have really rallied?
Yeah, I mean, I think firstly there is that time zone lag, as you referred to, and maybe the Aussie market wants confirmation from the US market. And if that's the case, we can potentially expect more decisive price action once Wall Street opens and digest that news, as Australia often takes its cues from US equity markets on these things. But I think also there's the court reversal. While positive for global trade sentiment, it introduces legal and political uncertainty, and there's ambiguity about how the administration is going to respond. I mean, obviously, they've already come out and said it's not up to unelected judges to decide what is a national emergency. And so I think because of that ambiguity about the response and potential appeals and the practical timelines, investors might be a bit cautious trying to figure out how that situation evolves.
Another key piece of corporate news coming out of the US implicating markets is those that result from AI chip maker NVIDIA. NVIDIA is the second largest listed company in the world. Overall revenue up 69% in the quarter. And it's a big number because I think it's around $44 billion just in 3 months, right? Driven by its data center business. Run us through the results. Why are they important? What does it say about tech and AI? And what does it mean for investors? Because its CEO also said some pretty peculiar comments about the implications for China in all of this.
Yeah, I think, NVIDIA was a good result, as you said, so growing strongly. Data center growth was 73%, and that led to that overall revenue growth of 69% and net income growth of 31%. I think, as you said, there's two key aspects at play here. There's China and then fundamental AI growth.
So on China, firstly, if it wasn't for China, that net income growth would have been 50%, not 30%. And Trump's policies meant they could no longer ship H20 chips to China. So they took a $4.5 billion inventory hit. And revenue guidance was actually slightly weak, and that was because that China issue is still having an impact. But I think that it's been largely priced into where people are kind of looking at the share price of NVIDIA right now. I think the more important thing is the result demonstrated this huge underlying demand for AI. So the company talked on the call about a sharp jump in inference demand, and we feel that people are really underestimating how much token use is due to things like reasoning models and the rise of agentic AI workflows. I think on the call, the CFO said that Microsoft used 100 trillion tokens in Q1. Like I can't even grasp what 100 trillion as a number is, but it was a 5 times increase year on year. And reasoning requires hundreds of thousands of times more tokens per task than what you had in the previous one-shot inference. So when you were asking, ChatGPT something, a sort of simple request and answering, now if you kind of ask it to do reasoning first, that requires hundreds of thousands of times more tokens than it used to. And so we've seen this significant increase in AI use cases over the last 3 to 6 months, and that's a result of these models. I think the key issue for NVIDIA is whether the recent growth is a bubble that will then fade. Our view is, having seen more of these real world use cases develop, and also, I guess, being a real world use case ourselves, we're still in the very early innings of AI adoption.
So how has all of this flowed through to the way the Australian share market's performing today?
Yeah, I mean, I think you said before, it has been sort of muted. I think you're seeing it drive a sort of risk-on tone in the ASX generally, and tech and data stocks are kind of leading gains today. The flow-through does seem strongest in sectors with direct or thematic exposure to AI and digital infrastructure. You're seeing, I think, NextDC's actually had a pretty good rise today, and that just reinforces that sort of AI and AI infrastructure investment cycle.
Now, the economic environment is constantly changing, as we saw today when we talked tariffs, right? So what are you telling your clients, and where are the opportunities for investors, do you think?
Yeah, it's been a very tricky market to invest in over the last couple of months, just given all the geopolitical uncertainty and so many things at play. We're still in wait and see mode on tariffs, but what we've pretty much seen since Trump's inauguration and JD Vance's address at the Munich Security Conference is, global policy uncertainty and volatility. It seems par for the course right now. And on the other hand, and I guess we've kind of been speaking about this, the AI thematic continues hotter than ever, and we've seen the big names release crazier and crazier innovations. So I'm not sure if you saw it, but in the last week, Google released Veo 3, which was a substantial upgrade in AI video generation, basically generating synchronized audio, including dialogue, sound effects, music, along high-quality visuals. So it's actually becoming hard to pass like what's real and what's AI, which is a bit scary. But this is kind of along the advent of those reasoning models I talked about earlier, and shows how powerful these LLMs can be. It's just kind of taking over in terms of the use cases that we're seeing. So those two themes are actually dominating our portfolio. We have a substantial allocation to European defense names and a substantial portion to AI-related names. And they've both been doing really well, but kind of been doing well in different ways and in an uncorrelated fashion. So it's been working really well to have those two counterpoints in our portfolio. We think the structural shift in allocation of GDP towards defense spending in Europe is still not being fully priced in. And equally, we have only just scratched the surface of AI penetration. So, I think I mentioned to you before, we use AI. My firm has built our own proprietary software to use AI to discover sort of idiosyncratic opportunities within the market. So we've got those two big themes that I just talked about. And then the AI for our fund is actually discovering a whole bunch of idiosyncratic opportunities. So we also have a big position in a Japanese talent agency for VTubers, a Polish game developer, and an Aussie recycled titanium play. And so I think that's a good way of thinking about how to invest as well, is look for opportunities that aren't being too, bandied around by what's happening in sort of global macro markets at the moment.
That is Mina Rosenberg from Minotaur Capital.
This SBS On The Money podcast is provided for informational purposes only. The content on this podcast should not be understood as constituting advice or...
How the Australian dollar, a closer look at the impact of the Fair Work Commission's increase to the minimum wage, gold and oil prices surge, and how the Australian dollar has been hitting petrol prices. All of that and more next. Hi everyone, it's Tuesday the 3rd of June 2026. Later we'll take a closer look at the direction for petrol prices and how the Australian dollar has been impacting it despite a fall in the oil price. First to the Australian share market, which rose 0.6% to 8,466. And it also comes as the Fair Work Commission approved a 3.5% rise in the minimum wage to $24.95 per hour. And that's above the rate of inflation, the annual rate of 2.4%. To discuss that and more, I spoke with Julia Lee from FTSE Russell.
Great news for a lot of workers that are on minimum wage. And if we have a look at the portion of the Australian workforce, it's about 21% of the workforce, or around about 2.9 million workers. They're going to receive an increase of 3.5%. Now, if we have a look at the first quarter trimmed mean CPI, we saw it falling down to 2.9%. That's the first time since 2021 that we've seen it between that 2 to 3% band that the RBA aims for. And when we have a look at how things like wages impacts on inflation, generally an increase in demand sees an increase in prices, and a decrease in demand results in a decrease in prices. So if you can imagine 21% of the workforce seeing a bit more money coming through the door, usually there's an inflationary effect there. So inflation is going to be an important one for the market to be watching, especially when it comes to interest rates.
When we talk about the markets today, what's driving it, and is there anything investors need to be aware of as we approach the end of the financial year?
The good news is that we are seeing an uplift for the market today. Of course, one of the key things that the market is watching is tariffs. And the fact that we have seen some of those tariff pauses being extended until August has been positive news for the market. Of course, the show is not over there, so just watching the headlines, and it does look like the US has asked for any tariff deals to be done to come to the table sooner rather than later. So it does look like more headlines could come to the market relating to those tariffs. The end of financial year is also an interesting one as well. And that's because we do see activity related to the end of financial year. Generally, investors, they tend to look at cashing out of some of their investments that haven't done so well in order to collect those tax losses. And some of those underperformers for the year, when it comes to July, sometimes we can see a bit more of an uplift in terms of July if they haven't performed so well in June. So looking at potential tax loss selling, usually that hits the underperformers, but those underperformers, some of them are generally bought back in July. So watching for a potential uplift there.
If we look at the performers on the market today, there's one that really stands out. That's IDP Education shares, down quite significantly. What can you tell me about that?
Look, this is a company that looks at international students and services. And when you have a look at migration policy or immigration policy here in Australia, as well as other countries, that's had a negative impact in terms of its outlook. We have a look at migration policy that's changed in Australia as well as in Canada. And there's a white paper on migration in the UK as well. And these are major destinations for international students. So how that relates to IDP is that it does mean saying that it expects lower international student placements. That's expected to be down 28 to 30% this financial year. Lower English testing volumes, that's expected to be down by 20%. And of course, that means a downgrade in terms of its earnings, which is expected to come in between $115 million to $125 million in terms of earnings before interest and tax. It not only hits FY25 this financial year, but it also has an impact in terms of the outlook for the next financial year. So it looks like a business review also on the cards there, and a very steep fall in price to reflect that outlook, down as much as 40% today.
Julie, we also saw a big rebound, though, in commodity prices today, particularly gold and oil. Why?
Well, oil specifically, we've seen an OPEC Plus decision, and it does look like 411,000 extra barrels of oil will come to the market a day. Now, that seems like a negative for oil price, but that's less than what the market was expecting. What we are seeing is OPEC Plus, that group is trying to normalize some of the oil cuts that we have seen over the last 5 years that has been in place to support the market. Gold, on the other hand, is benefiting from an increase in geopolitical risk. We have a look at the gold subsector. It's doing very well on the market today. And in fact, if we have a look at over the last 52 weeks, the gold subsector has been up a huge 73%. So no doubt, a lot of happy gold investors in the last financial year.
Now, it's interesting to see that the oil price rising, even though we're getting some mixed news out of China. China manufacturing activity falling to its weakest level since September 2022. So what's your take?
Carter, you're absolutely right. China has a big impact in terms of our materials as well as our energy sector, probably more so in terms of our bulk miners like Rio Tinto as well as BHP Billiton. Today, unfortunately, some bad news coming out of those factory orders and activities. The Caixin survey showing a drop below that 50 mark, which separates contraction from growth. So coming in at 48.3 points. I guess what we are seeing is that tariffs are having an impact in terms of factory activity, and in particular, new export orders have been hit quite hard here. So just watching those factory orders and I guess those tariff conversations that are happening between the US and China.
And finally, we heard from the RBA today. It released its latest board meeting minutes. It said that it did indeed consider a 50 basis point cut last meeting, but still went for 25. What's the market now pricing in terms of future interest rate cuts?
We've actually seen the Assistant Governor, Sarah Hunger, with a speech today in Brisbane, and it does look like the RBA not only considered an outsized move, but also a tariff peace situation. So it does look like there was a bit of scenario analysis happening with the latest RBA meeting, which saw interest rates here in Australia drop to 3.85%. We have a look at what the market is predicting. At the moment, it's predicting another 225 basis points move, so down to 3.2% by the end of the year. But a lot of that is going to depend on the policy outlook. And as Sarah Hunger pointed out today, it's very difficult to predict those policy decisions when those conversations are ongoing at the moment.
That's Julia Lee there from FTSE Russell. From the share market to petrol, where the ACCC says average petrol prices rose in the March quarter despite lower oil prices because of a weaker Australian dollar. To explain, Raina Bosch spoke with the Commonwealth Bank's commodity analyst Vivek Dar.
So, Vivek, the ACCC has today released its petrol report for the March quarter, which showed an increase in prices. Now, that's despite oil prices having fallen largely over that period. The Australian dollar has been blamed as the main driver. What's your take?
I think it's very much an appropriate take. In terms of how we really look at what's driven petrol prices in Australia, it's really been that oil price and then that Australian dollar. And the fact that we've seen it weaken so much in that first quarter, it explains very much why you would see higher petrol prices in the March quarter.
Looking at the current petrol environment, though, and the broader economic environment, the Australian dollar is going back up again. It's sitting around that 65 US cent mark. We then have oil prices, which are sitting around 60 to 65 US dollars. So how are things looking for you at the moment?
So look, it's probably a really good time to give a forecast because our view is for the oil to stay around $65 a barrel, and we have the Aussie dollar moving to about 66 cents by the end of the year. So in terms of where we think steady state is, we are thinking, in that $1.70 to $1.75 a litre for petrol. And that's really where our expectations are in the second half of this year. But if I had to say where the risks are in the very near term, I would say that there is a risk that prices may lift. And some of that is being driven by a lot of the geopolitics that are playing out right now. So on the one side, we have talks between Russia and Ukraine not panning out, and people are worried that could see Russian supply at risk. But the one thing we'll warn is, yes, markets will be worried about that, but it has been extremely difficult to limit Russian oil exports. We saw sanctions earlier this year delivered by the Biden administration before he left, and that had a very minute impact in terms of Russian oil flows. So we think the market is a little overdone on that, and that it won't really materialize. But where markets have really got some concern is Iran. Because of the fact that they can't get through this deal in terms of this US-Iran deal over the nuclear program in Iran, we could see potentially sanctions enforced, and that could sideline about 0.5% to 1% of global supply. That was our expectation, even before the Trump administration came, but that is something that could certainly play out in coming months. But even worse than that is there is the threat of military violence in the Middle East, which if it particularly targets Iran, that could certainly see oil prices rise quite a bit. So I think those concerns have priced in, and that's pushing that oil price higher. And that's probably the near-term risk, we would say, to even petrol price in Australia, is that it could rise. But overall, I would say the risk, if I looked past the next few weeks, would certainly be that prices could crack back down to about $60 a barrel. Our worry right now is that OPEC Plus are going down a strategy where they're trying to limit US oil production growth. And that means that they are targeting Brent oil future prices of about $60 to $65 a barrel, close to the $60 barrel mark. And that is something that could put pressure on the other side. So we are watching this space very, very closely. But on the case where prices do fall for oil, which is our risk scenario, we could see petrol in Australia come down to about $1.65 a litre. So that's something that we're looking at very closely. But that whole paradigm now in oil markets is geopolitics on the one side and OPEC plus strategy on the other.
Now, these threats obviously are still yet to really materialise, yet the Australian Institute of Petroleum said that last week petrol prices here in Australia, at least on the retail level, went up between 5 and 6 cents a litre. Why is that?
So look, if I had to step back and look at some of the other drivers right now, yes, like one aspect has been that oil has lifted and that has an impact on sentiment. But I would say some of the other factors, which we don't really include as the primary drivers right now, given it's been largely stable, is refinery margins. So refinery margins, when we talk about oil, you have the oil price. But then if you look at petrol, you have to have the refinery in the middle, and their margins matter. Now, those margins have actually increased because we've seen refinery outages around the world. And this is something that, because it has lifted, that does translate through sometimes to higher prices. And this certainly was the case when the Ukraine war started. This completely dislocated markets, and that's why, diesel prices certainly lifted in that period. But the slight increase we've seen through this year on refinery margins has been a factor, which I think probably played through in terms of higher petrol prices. But we don't think of it as so significant relative to oil prices and the Aussie dollar.
That's Vivek Dale there from the Commonwealth Bank. Don't forget, if you enjoy the podcast, to give it a rating or review on Apple Podcasts and Spotify, and to click subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation.
Okay, I'm in a biscuit. Holy shit. Okay, I'm going into my sector in the mix. Goodbye. I love you.